Very good morning, friends. At the outset, let me thank each and every one of you for the overwhelming response you have given for this fast track webinar series. We are on the final day of BIndAS batch 6, day 5. This is an exclusive session for ICAI certificate course on Indian accounting standards. Today, we are going to discuss with two very important standards. One is on IndAS 33. Another is on Indian Accounting Standards 23. These two standards are going to do wonders unless and otherwise you appreciate the content and the intent behind that. Do you need a standard for an EPS? And what is so special about borrowing cost? It's just an interest. So let us understand these two parts very clearly. And once you appreciate the purpose, the objective of this standard, I am sure you will really like Indian accounting standard well, and the purpose of bringing a standard also will be very clear. So let me take you through the normal formula for an earnings per share. Now, before I take you to this subject, I just want to share with you the purpose of this particular standard EPS. Now, let me take you to the standard directly. Okay. So this is the objective paragraph, the para number 1. And here, I'll take you to the 33 part. Yes. Especially, I'll share with you the look at this para number 1. Very important paragraph. Why this particular standard? The objective of this standard is to compare the earnings per share. Is only for compare. The principles for determination and presentation of earnings per share. Now, normal wordings will be measurement, recognition, and disclosure. Of course, identification. We call it as IMRD. Okay, so identification of the transaction, measurement of the transaction, and recognition of the transaction, disclosures. These are the normal. For example, you take IndAS 16 on property, plant, and equipment. They only speak about IMRD. This is one standard which doesn't speak about IMRD. It only speaks about determine and present. Okay, so you can call this as a DP standard. It's actually a DP standard. Determination of earnings per share. And you have to present the earnings per share. My God. So I'm going to share with you some interesting annual reports. So especially Marico, Shriram Housing Finance, Tata Power, and many more. So unique annual reports I'll just share with you, where the purpose of an earnings per share, the earnings per share compared to your book value, that is your market price of the share, book price, book value per share, face value of the share. So people will compare this EPS with your market price. And if a company is market price is 250 and earnings is 25 rupees per share. Oh, very good. So you have to pay 10 times of the earnings to buy the share. So that means to get your money back, technically, it will take 10 years. Okay. So there are thumb rules. So for example, if it is 15x, 20 times of the earnings. Okay. Sometimes your market price will be too high compared to earnings. So then it is not worthwhile investing. So that means it's overpriced. So that earnings per share is a very determining factor. So whether to go for a investment or not. So that is why it has to be determined and presented by the management when they are presenting their financial statement as part of it. And for your information, Schedule 3 also in the format last one line, you have the earnings per share. But this earnings per share is basically a formula. Okay, please look at this. This is a formula. Okay, this formula is a division. Look at this numerator by denominator. This is numerator by denominator. Okay, now IndAS 33 is a denominator standard. One line we can say, just one line. Look at this paragraph. Look at this paragraph. Even though EPS data have limitation because of different accounting policies. So to bring a common method of doing this arithmetic. So earnings per share is a ratio. There's no accounting here. Where is accounting? So you cannot say you measure it and recognize it. Nothing. It is analysis of financial statement. EPS is a standard which is analysis of financial statement. So it is not technically an accounting related standard, but a presentation related standard. How do you present your financial statement? You need to have this information in your. So that is why EPS is, can you say it is a disclosure standard? Okay, you can call it as, but these informations are analysis, your financial statement analysis, and consistently determined denominator enhances financial reporting. So that denominator, please look at this, this word, look at this part. Look at this. Your numerator is rupees, your profit after tax. Denominator is number of shares. So lesser the number of shares, earnings per share will go up. More the denominator. So lesser the denominator, EPS goes up. Higher the denominator, EPS will come down. So we have a interesting arithmetic before us now. So the focus of this standard is on denominator of the earnings per share. So please pay the kind attention, but it is not only on denominator, numerator also. So this entire standard will only speak about what should be numerator, what should be denominator. Okay, good. So now this standard is about 73 paragraphs, and you have definitions. You'll be quite surprised with these kind of definitions. Okay, now I just want to share with you with respect to consolidated and standalone, I mean the separate financial statement. Entity shall not present in consolidated financial statement EPS based on the information given in separate financial statements. So you have the individual financial statement consolidated also, and shall not present in separate financial statement EPS based on information given in consolidated. Now, what is the meaning of this? Okay, so if it is consolidated, EPS disclosure is there. EPS computation should be based on information given in consolidated, and separate, yes, information given separate financial statement only. Okay, information given in consolidated financial statement only. So entity shall not present in consolidated financial statement EPS based on information given in separate financial statement. So sometimes what will happen? Okay, what is the message of para 4? I'll tell you. So sometimes your consolidated financial statement EPS will be low. Individual financial statement EPS will be high. So what I will do, I'll replace with this. Can I do so? No. The reverse also will be there. Consolidated financial statements EPS will be higher. Individual financial statement EPS will be low. Oh, what is this? So that means can I replace your individual financial statement consolidated? No. Since it is only number. Okay. These kind of juggleries and all people can do. So that is why this para 4 also I'm bringing it to your attention. Okay. So now let me take you to question number 1. Okay. So some of the interesting question let me take. Okay. So I want to take you to the definitions part. So first let me take you to what is meant by ordinary share and potential ordinary shares. Now, to understand these two, I am taking you to certain annual reports. So I will not take you to some complex annual report. Simple annual reports I will take. Simple. This is actually power grid. Look at power grid, guys. Okay. In power grid annual report, look at the, of course, these are all your only in P&L account, we will have this. Okay. Look at this. Your basic and diluted EPS. Okay. So both are same. Okay. So regulatory deferral account balances, regulatory deferral accounts are applicable only for companies like power companies. Okay. Where we have a separate regulators. So power, we have a separate power regulator. So where the tariff is actually controlled. So we have a separate accounting standard also for this. So and there can be in exam question can also be on the regulatory referral. So I'm not discussing that particular part. I'm only in this part, basic and dilute. Now I'll just share with you one more interesting standard. I mean one more. This is with respect to a company called which is this company? Titan. Look at Titan, guys. Okay, Titan annual report. Look at their look at their total earnings per share. I mean, by basic share, 24.56. Diluted is also 24. Now, both they are disclosing. Actually, both are same. So that means the numerator is same, denominator is same. Then why this two disclosures they are giving? Okay, please wait. So power grid, you had some. They gave both put together same. There is this basic and diluted. They didn't show separately. They said both same. Okay. And with the Titan, they are giving two separate lines. Now I'll take you to Marico. Marico. Where is Marico? Okay. This is what is this? Torrent. I want to take you to Marico. This is Bajaj Auto. Marico, Bangladesh. Okay, look at this. So very interesting number. Look at this. So I just want to take you to their balance sheet. First, P&L account, then I'll come for their notes. Look at their P&L. Look at the P&L. Amazing. This is your earnings per share, basic earnings per share. That's all. Okay. So they are not disclosing diluted. Now, I'm just showing you this is not an Indian balance sheet. Okay. So I just show you that how Indian balance sheets are unique and different. Okay. And we have this. Look at this. This is in a different currency also. This is based on IFRS. Okay, that is IAS 33. So as per IAS 33, so I'm giving so how our Indian accounting standards are superior. Okay, so this one example will tell you that difference. Earnings per share, the calculation of diluted earnings per share does not assume conversion, etc. Now, what is this dilution? I will tell you. So that would have an anti-diluted effect. The company has no diluted instruments, and hence reporting a diluted earnings is not applicable. So they are not disclosing. Even though in our Indian accounting standard, both are same. Both are same. We are disclosing both. But in international accounting standard, if both are same, one is not disclosed. Okay. So that is why I'm giving you that fundamental difference. Now I'll take you to Shriram Housing Finance and Tata Power. Wow. This is actually Tata Power. And I'm taking you to Shriram Housing. This is Shriram. Where is this? Shriram. Now here, I'll take you to the EPS part. Look at this EPS. Yes. Yes. So I think I'll take you to the P&L account. So this is your profit and loss. In the P&L, please look at two lines. Both are not same. So that is why I'm bringing it to your kind attention. The fundamental difference between both these P&L. Earnings per share, face value 10 rupees, basic 2 rupee 82 paisa. So out of 10, 28 rupees is earned. So diluted 2.81. So what is the market price per share? So I will take you to the beginning. So listed price. NCD is market price. Overall, so BSC, NSC. Just show you the price here. So we will understand where the price is. So I can tell you that. Not no problem. So anyhow, let us keep in mind that. Sorry, where is it? Shriram Housing. Earnings per share. It's here. Branches, earnings per share, market price, asset under management, net worth, okay, total revenue, their market cap they will give. So that market cap you can, they are not given market cap. If market cap is given, you can find out, of course, once you know the earnings and the market price as on 30th March, you will know how many times it goes, okay. I thought of showing you that particular part also, doesn't matter. Now look at this. Yes. So now you have the basic EPS and the diluted EPS, two separate items. Now, how do we calculate this? That is where I am going to take you into the look at this. So the basic EPS is calculated by dividing. So this is actually an arithmetic. There is no accounting. So I'm not going, this particular standard is very simple standard. Okay, very, very simple standard. Now look at this questions. I'll take you to one of the questions. Okay. So how are you going to calculate this basic EPS? Net profit after taxes, okay, which is attributable to equity, divided by weighted average number of equity shares. So how do you calculate this VANOS? So I'll be doing some 1 or 2 questions on this. Okay. And this diluted EPS, what is this basically? Diluted is sometimes you would have given, like for example, ESOPs, an employee stock option plan. You would have given convertible preference shares. Okay. You would have given convertible debentures. Now we call it a CCPS, compulsorily convertible preference shares. CCD, compulsorily convertible debentures. That means today it is debentures, tomorrow it is equity. Today it is preference, tomorrow it is equity. So therefore, your denominator is going to expand. The denominator is going to expand. So normally, what will happen? Numerator by denominator, you have a 2.82. And this diluted EPS, you dilute, you add your denominator. So the denominator will goes up. Once denominator goes up, your earnings per share will come down. But necessarily, should diluted earnings per share should be lesser than basic earnings per share? Not necessary. Both can be equal. I gave an example. And your international accounting standard, they say both are equal. Don't disclose diluted EPS at all. But our standard, okay, especially this is what I want to give the difference. Para 5. Ordinary share is an equity instrument that is subordinate to all. That is ordinary equity. What is potential ordinary? It is may entitle is older to ordinary share. May entitle. So options. Okay. So we have various definitions of ordinary. Look, these are all potential ordinary shares. So like options, sometimes liability will be converted to equity. So I will not pay the liability, but I will give equity instruments and settle it. So including preference shares, convertible into ordinary. Okay. So options, warrants. So currently take the money, give warrant, and later 6 months later, and of course, a listed company, you have a maximum 18 months time to actually convert your warrants to share capital. So then Those are all potential ordinary shares. So your denominator should increase. Now, I want to give an interesting arithmetic here. Okay. So let me take you to some of the questions and then while calculating the basic earnings per share. Okay. So I'll take you to this para number 19. Look at 19. For the purpose of calculating basic earnings per share, number of ordinary shares shall be, because sometimes what will happen, your opening number of equity shares, closing number of equity shares, both are same. Very good. Now, opening shares is 20,000, closing is 25. That means 5,000 you issued during the year. So then, will it take 20 or 25? So 20 is there for 12 months. That 5,000 shares is only issued during the month of August. Let us say, August, September, October, November, December, January, February, March. So it is actually 8 months. So 8 months into 5,000, 20,000 into 12, whole divided by. So you have to find the weighted average number of ordinary shares. Okay. So what is it? So you will have the number. So how will you find the weighted average number of shares? I'll just give one example, one simple case study on that. So now please come to this particular question. For the purpose of calculating basic earnings per share, number of ordinary shares shall be average, weighted average, moving simple average, moving weighted average. So what your para number 19 says, shall be weighted average number of ordinary shares outstanding during the period. Okay. So that is your weighted average. So 6 is actually B. Okay. Now I'll take you to one simple, look at this. One interesting question on partly paid shares. Another interesting question on this time factor. So just now I was discussing about this weighted average. Now look at this. This is the data about a company for 21-22. Now, 1st April, you had 1 lakh shares. 15th June, you issued 75,000 shares. 8th November, converted preference shares to equity 50. 22nd February, you bought back the shares and cancelled it. Okay. So that is reduced. Okay. 20,000. 31st March, you add 1 lakh plus 75, 1 lakh 75 plus 50, 225, 225 minus 20 is 205. Now, is the denominator 205? No. So you have to take that. This is actually 1st April, 12 months. 15th June means so how many months you have to take. Okay. So this is actually number of days. You can take 365. This is 290 days. And your 50,000 is 144 days. Buyback is on this particular date. So because all are not in month end, it is in between. So you can take a number of days. So 38 and the closing balance is 205. Whether you will get 205 here, no. So add this. So your weighted average, so 1 lakh into 365 by 365. 75,000 into 290 by 365. 50,000 into 144 by 365. Minus 20,000 into 38 by 365 is minus 2,082. Okay. So add all this, you get 177, 233. This is your VANOS, weighted average number of shares. Okay. So this is with respect to time weighted average. I'll take you to another. So this is your third question. I'll take you to disclosure part. I'll come later. Look at this partly paid shares. There also, it is 1 rupee share of for it's an ordinary share of 1 rupee each for a consideration of 2.5 per share. Okay. Cash of 1.75 per share was received by the balance sheet date. The partly paid shares are entitled to participate in dividend for the period for proportion. Now, how will you calculate the number of shares in this particular case? So, out of 2.5, 1.5, 1.75. So, you get a percentage of, so 2.5, the 1.75 divided by 2.5. So, that means 70% is the weightage given for this 1 lakh shares. So, I will only take 70,000 shares. So, one is a time weighted, another is partly paid. Now, if this partly paid is during the year, time weight also you have to give. So, partly paid also you have to give a weightage, time also you have to give it. Now, if this 1 lakh is outstanding from opening till closing, so then no need to give time weightage. So, please understand this. So, this VANOS is a very interesting concept. Now, I will take you to one more interesting point in this. Okay. Now, with respect to dilution, okay. Now, I want to make this observation here. This is actually Shriram Finance. Okay. Now, please look at this. Diluted EPS is calculated based on the net profit attributable to equity shareholders after listing. Now, which paragraph says this? No? I'll take you to para number. Okay, I'm here. Okay, so I'll just take you to the diluted part. Look at this. This is your diluted EPS. So an entity shall calculate diluted EPS attributable to ordinary shares. Okay. Oh, so this continuing operations also I have to mention. My God. Okay, and discontinued operations. So now, yesterday we were discussing about this continuing operations and discontinuing operations by a separate standard. Okay. So especially the held for sale. Okay. The property, plant, and equipment when it is held for sale. Okay. So what to do? Asset that has been retired from active use and the discontinued operation. So we understood that part. Now I'll just show you one Tata Power's. This is Tata Power. Tata Power's consolidated financial results. Please look at this. My God. This is basic and diluted earnings per share from continuing operations 1.01. From discontinued operations negative. Okay. Continuing operations have to, this is actually regulatory deferral balance also separate standard. So now I'm connecting three standards. Okay. So I'm connecting three standards. Of course, regulatory deferral accounts, so we have another separate standard for that. So there they give one more prescription that your earnings per share also should be specified separately. Okay. After and before net movement of regulatory deferral balance. Now, continuing operations also you have to give EPS. Discontinued operations also you have to give EPS. My God, this look at negative. Now look at discontinued operations. Okay, this is continued operations. Net profit from continuing operations. Profit and loss from discontinued operations negative. Wow. Okay, so there, this is that means from continued operations you earn. From discontinued operations, it pulls down. Oh my God. So shareholder wants to know why you are keeping this. It is pulling down our earnings. You sell this. So why this separate disclosure? Okay. See, giving this absolute number will not help. You have to give the specific number. That is going to total operation and net movement. So this is very interesting. Basic and of course basic and diluted here both are same. So that is why they have not given basic separately, diluted separately. Okay. So denominator is same. There is no what do you call it as convertible preference, convertible. Now, when you have the convertible preference and convertible debenture and maybe options, ESOP, then your numerator will change. Yes. Now, what will happen? Sometimes I just want to bring it to your attention to this particular paragraph. For the purpose of calculating diluted, and it shall adjust profit and loss. Oh, look at this adjustment. For the purpose of diluted, an entity shall adjust profit and loss after the tax effect. So, anyhow, your numerator is profit after tax only. Will you subtract or will you add? Now, if it is, for example, your basic EPS. The basic EPS is after preference dividend. So, profit after tax minus preference dividend divided by number of ordinary shares. This is your normal formula right from plus 2 BCom, MCom and all. We would have done it. Now, diluted EPS. Now here you have to do an adjustment. Okay. So that is why never jump to a conclusion that, okay, basic EPS will be higher, diluted EPS will be lower. This is a normal thumb, but the thumb can be like this also. No? So therefore, any dividend or other item related to dilute to EPS deducted in arriving at profit and loss account. Okay. So to ordinary shareholders as calculated in accordance with para number 12. Any interest recognized in dilute to potential ordinary shares. Okay. Is calculated after the tax effect. For example, you have this concept of what is your potential ordinary shares. Potential ordinary shares is ESOP. Now, ESOP, you are not allotted at all. So, therefore, once it is vested, not allotted. Okay, not allotted, but vested. That means they have the right for the share, but you are not allotted to them. So, then, will you give dividend for them? You will not give dividend. Now, sometimes it is different. Preference is there. So, preference shares are there. Then, these preference shareholders, they will become equity only 5 years later. But the agreement will say, since already given money, the current year dividend, preference dividend, give me 8% or 10%. Surplus also you have to give me dividend. So therefore, this particular dividend, will you subtract it? Normally, earnings per share, basic EPS, what did you do? Minus preference dividend. Okay. That minus preference dividend you will not do. You will add preference dividend. Divide by, you will add that preference preference shares which will be converted to equity shares. So therefore, numerator also will go up. Denominator also will go up. So will diluted EPS will be greater than basic EPS or lesser than basic EPS is you cannot give a generic answer or you cannot give a thumb rule. It depends upon the calculation. So therefore, normal dilution means only denominator will go up, not necessary. Your numerator also goes up. Very, very important paragraph. Now, I want to bring to your attention one more question. Look at this. Now, you have negative. See, just now we saw this answer, guys. You have this negative of discontinued operation is negative. So, therefore, you have a negative EPS. So, there are other companies who are negative also, who are loss making, listed company loss making. So, earnings per share, will it be positive or negative? It will be negative. Okay. So, according to IndAS, an entity shall present basic and diluted EPS. Even the amount is negative, there is loss per share. Is it true or false? So, what I will do, I will take you to a paragraph. Look at this paragraph number 60. Okay, look at 68 and 69. Very important. Entity shall present basic and diluted EPS, even if the amounts are negative. Now, I want to bring to your kind attention one more question. Okay. This is the question. This is the point I discussed. An entity that reports the discontinued operation, negative, shall disclose basic and diluted per share for the discontinued operations also. Either in. So, look at this part. So, this is your before net movement. This is after net movement because you are committed to deferral. Your what do you call it? You make a surplus, then the regulator. You are committed to a regulator, so you have to pay to the regulator also. So that particular part is so before regulatory deferral balances. Deferral means you pay later. Okay. So you subtract that, you get 0.53. 0.53 you subtract 7 paisa, it is 46 paisa. Simple. So if regulator is not there, oh, we make 1 rupee. For 10 rupees, we make 1 rupee. But because the regulator is putting all these constraints, you have to pay 47 paisa to regulator, 48 paisa to regulator. Net only we get 53 paisa. And discontinued, because of discontinued operation, 7 paisa loss. See, where I earn 1 rupee from operations. But what is left to shareholder? 46 paisa. So now shareholder will take a decision in AGM. What should we do so that we retain that? Well, it's a very, very, very important, I will say, Indian accounting standard to actually appreciate the business sense. Okay, the net business sense converted all these converted to the net business. So therefore, actually, rather than an accounting standard 33, IndAS 33 understood by a chartered accountant, it should be more understood by an investor. An investor understands. Maybe he may not understand how the numerator denominator will be, but he understands the business part of this. So therefore, stock analyst and the other people who actually do the comparisons of the companies who are in the same industry, they take all this. This company is doing well, this company is not doing well. A very, very important number to actually start your analysis. Okay, good. So now let me take you to so I think one thing I should share with you guys, that is about 33. Okay, 33 is very special. Why? Because the lunar solar cycle takes 33 years. Now, what do you mean by the lunar solar cycle? A lunar year is approximately 354 days. Solar year is 365 days. So that means there is a gap of 11 days. This 11-day difference between one solar year and one lunar year results from the difference in their definitions. So the term EPACT describes their time differences. This means it will take another 33 years for the cycle to return to its original position. So every 33-year calendar will be same. Okay, so and we have 33 devas. Okay, the large number of devas are there in Rigveda. 33 devas are counted. 11 in earth, 11 in space, and 11 in heaven. Okay, so therefore 33 is very special, very, very special. And similarly, 23 is also special, guys. Okay, your earth axis is not straight. Earth axis is tilted 23 degree. Okay, and human cells have 23 chromosomes. Okay, and other human cells have 46 chromosomes. Normal human sex cells have 23 chromosomes. Okay, so other human cells have 46 chromosomes arranged in 23 pairs. So this only decides the male or female. Okay, so the fetus, male or female, is decided only by this particular 23 chromosomes. Therefore, borrowing cost, whether it should be capitalized or not, okay, whether it is male or female, that is decided by IndAS 23. Okay, good. So now I'll just bring it to your kind attention. This 23, very, very simple standard, but very effective standard. Very, very effective standard. There are certain paragraph I want to bring it to your attention. Now, please look at this core principle. See, I told you yesterday when we were discussing 108. See, 108 is operating segment reporting, operating segment. Okay. So now I told you all the standards, they have principles. I repeat, they have principles, but I'm sorry, the objectives are there. This is the only standard. I said there are two standards where core principle will be there. So your operating segment as a core principle and your borrowing cost as a core principle. So what is borrowing cost? What is special about borrowing? Anyhow, you are going to pay interest. So why you need a standard for it? Okay. So similarly, IndAS 33 also, why you need a standard? Your numerator, denominator. Okay. And the connect between your IndAS 33 with your deferral accounts. So look at this deferral accounts, guys. This is where I'll just share with you. Look at this. This is your deferral accounts. So regulatory deferral. So IndAS 114. So here they speak about the earnings per share. So here they speak very clearly. So classification or regulatory deferral account balances. How do you do it? Why this particular standard is a special thing, and is only applicable for a classic example, the power company. Torrent Pharma is that is not applicable. Okay, of course, pharmaceutical industry, provided you do a generic drug and a special drug. Okay, so then the drug price control order is also applicable for certain drugs. Okay, so the regulatory deferral account balances are what is that? Why it has to come? You need to understand. I'm only after going through this. So you have a connect between this 114 and 33. And also discontinued operations. So that is 105. Okay. So 105 is this. Okay, discontinued. So 105, 114, and 33. So connect between all these three is your earnings per share. Okay. Now coming to borrowing cost. So yesterday we discussed about 108 operating segment. This 108 also has core principle. I told you. This also has core. All other standard doesn't have core principle. They have only objective. So what is this core principle? Borrowing costs that are directly attributable to ACP. Okay. Form part of cost of the asset. Okay, it's very, very important. Otherwise, you are expensive. Normally, interest will be debited to P&L account. Okay, will be charged. Expense. So borrowing costs attributable to buying an asset, constructing an asset, producing asset, that is your closing stock, your products, okay, or services, provided it is a qualifying asset. Okay, the word that is used for substantial. Okay, there is a word that will be used, and nowhere you have an answer for, you have an explanation for substantial. So that is why management is given the comfort. I'll come to that. So the qualifying asset, so I told you this, especially this core principle 108, look at 108, operating segment. Entity shall disclose to evaluate the nature and effects of financial. This evaluation power is given to management. Okay, the evaluation power. So that is why companies like Ashok Leyland, Asian Paints, they were not disclosing itemized information. Okay, so that evaluation. So here the power is given to qualifying asset. Who will decide? So substantial. I'll come to that definition part. Very, very interesting terminology. Now, where is it? So this standard is not applicable to imputed cost of equity. So I'll come to this third one. This standard does not deal with the actual cost of equity or imputed cost of equity, including preference capital not classified as line. Now, what is this? Okay. See, you say borrowing cost. Actually, this entire standard is over if you understand two things. What is borrowing cost? What is qualifying asset? Katham. I will say Katham. That's all. So, borrowing cost is interest. Now, you pay for preference capital interest. Okay. Including preference capital not classified as liability. Very important. Preference capital not classified as liability. That means if preference capital is a liability, that means preference shares not classified as liability. That means when it is classified as a liability, you are going to repay. When you are going to repay, this year itself I am going to redeem it. Then it will be a liability. It will not be equity. So please understand this. So then the interest part will come under borrowing cost. Now whether it has to capitalize or not, next question. So capitalize qualifying asset forming part of the cost of the asset. So that means this is one particular standard where liability will be there. On the liability, it will be borrowing. There will be a cost for the borrowing. Borrowing will have a connect to an asset. Now, whether this interest we will capitalize it or take it to P&L account. This is where the entire discussion is all about. And equity cost, preference not classified as a liability will not come. But preference classified as a liability will come. Okay, so please understand this part. Now I'm coming to this question. Imputed cost of equity may not be eligible for capitalization borrowing as under IndAS 23. Okay, so is it true, false? Not applicable to IndAS 23. None of the above applicable. So now you have to imputed cost may not be eligible for capitalization. Actually, what is imputed cost of equity? Equity, is it free of cost? No, it has a cost. The imputed cost is the cost of equity is the costlier than debt capital. Okay, because entire return belongs to them. Risk is there. Higher the risk, higher the return. So therefore, that is why I am taking you to this particular paragraph. Does not deal with cost of equity. Okay. So not applicable to IndAS 23. So this is one part. Now I am taking you to substantial. This is the very, very important terminology where I will take you to para number 5. This standard uses the following. What is the number one? Borrowing cost qualifying. I told you, no, only two paragraphs. Okay. So only two standards. The two definitions. Para 6 to 1. 5.1, 5.2. What is borrowing cost? What is qualifying asset? So qualifying asset is an asset that necessarily takes a substantial period of time. Now, what is substantial period? Has it anywhere they have discussed about substantial period? No. It has not been discussed. It has not been discussed. To get ready for its intended use of it. So substantial period of time, it depends upon your business. So that is why please look at this. Qualifying asset. So this is the entire, that is why I'm taking you to one particular question. Okay. So Boilers Limited purchased from BHL, a heavy machinery on 30th September at a cash discount of 5%. Okay. So that means, so 5%, 30 lakhs at a cash discount of 5%, invoice price of 200 lakhs. Okay. So 30th September, 5% cash discount and invoice price of 200 lakhs. Now 200 into 95%, which is 190 lakhs. Okay. Other expenses incurred were transit insurance 2 lakhs, transportation 5.5 lakhs, foundation laying expenses 4 lakhs, installation charges 2.5 lakhs. Now it is very similar to your, your property, plant and equipment. So add all this. So plus 2 lakhs, that means 192 plus 5.5. That means 197.5. Foundation laying expense plus 4 lakhs. So 201.5 lakhs. And installation charges 2.5. 2.5 lakhs. So it is, sorry. So I think I missed it. So you have 200. So it is it is 119 plus 2 plus 5.5 plus 4 lakhs, which is 201.5 plus 2.5 lakhs. So it is 204 lakhs. Okay, it is 204 lakhs. Good. Now the company had also borrowed a sum of 180 lakhs at an interest rate of 16%. So now this is your cost. So you borrow 180 plus add your own money and you pay 204 lakhs at 16%. The machinery was ready for use on 31st March 2014. Okay. I bought on 30th September. 30th September. The company had also borrowed a sum. Determine the cost of acquisition by applying the principles of IndAS 23. Now I am taking you to IndAS 23. Your cost. So what the cost says? Qualifying asset forms part of the cost of the asset. Okay. So I'll now take you to 5.2. This is your 5.2. What 5.2 says? That necessarily takes substantial period of time. Okay. Now in this paragraph, from 30th September 2013, from 31st March 2014, the company had also borrowed a sum of 180. Now, whether it is ready for use. See, the point is, if you have borrowed the machine, if you have borrowed 180 lakhs and still the machine is not ready for use. So I want to make a very important paragraph here. Recognition. The entity shall capitalize that are directly attributable to ACP, and I will only capitalize till it is ready for use. After it is ready for use and you are using it for your production, you have to charge up to payment. Now, by applying the, which states that a qualifying asset necessarily takes substantial to get ready for its intended use or state. So I am presuming that the machinery was ready for use at 31st March only. That means till 31st March, whatever interest you pay, you have to capitalize it. So now you have 204 plus interest. So what is your interest? 180 lakhs at 16%. We have to calculate. This is from 30th September. So October, November, December, Jan, Feb, March. So 6 months. So 180 lakhs at 16% is 28.8 lakhs divided by 2 because 6 months. So 14.4 lakhs. 204 lakhs plus 14.4 lakhs is 218.4 lakhs. So this is what you will capitalize. So 14.4 lakhs you will capitalize, and from 1st April 2014, it will be charged off to revenue. That's all. Simple. So now you have understood one thing. So what is meant by the substantial period of time? This substantial period of time, the standard is silent. Okay. Now I want to make one more observation here, especially. Okay. Depending on the circumstances, any of the following may be qualifying asset, like inventory. Now, inventory, you may have a regular time period to actually produce it. For example, inventory, you borrow the working capital, and working capital you actually use it for the purpose of manufacturing, and you make the product, and it is ready for use. Okay. Now, it takes a working capital cycle of say 6 months or 3 months. Okay. Now, this is your accounting policy here. Now, substantial period of time, will you consider this 6 months or 3 months a substantial period? Okay. Sometimes what will happen? Your regular inventory, if it is a regular working capital cycle, you need not consider that as a substantial period of time. Certain inventories, because of extraneous circumstances, may take some time. So therefore, whether you have to classify it, whether you will capitalize it to your inventory or you will charge a, especially with respect to working capital, is the accounting policy. So the standard is actually silent with respect to that. So I will come for certain interesting twist here. So financial assets and inventory that are manufactured or otherwise produced over a short period of time. Oh, just now I gave an example of 6 months, 3 months. are not qualifying asset. Now, what is short period of time? So, therefore, can I consider below 12 months a short period? Yes, you can consider. So, for example, I am a builder. I take 18 months, 24 months to construct the apartment. For me, that is inventory. So, can I consider 24 months as short term? I can consider, because my working capital cycle is 18 months or 24 months. So, therefore, the again short period of time, this substantial period of time, all these are subjective. So, I need to disclose this in my annual report. So, I'll just take you to one annual report. So, let me say, this is your, this is what is it, which company? This is a Titan, huh? This is Torrent. So I will take you to, this is this company I will take. What is this Titan? Bajaj Finster. It may not come here. This is what Titan I will take. Titan. This is a perfect example. Okay. So borrowing cost. I'll just take borrowing cost. Look at this. Borrowing cost or interest and other costs, including exchange difference. This particular paragraph alone has been inserted. For example, look at this 6A. Para 6A. Now I want to make one observation here. Okay. Carve in, carve out. What is carve in, carve out? You go to Vinayaka Chaturthi. We have Ganesh Chaturthi. In Ganesh Chaturthi, you buy Ganesh Murti. In Ganesh Murti, what will happen? You will have to beautify the Ganesha, the unwanted mud will be removed. Okay, so that we get a Ganesha. That's called carve out. So from IFRS, what is not required for India, we carve out. That paragraph we remove. Okay. Now, to beautify, to give a desi feel, to give a divine feeling, so that the Ganesha, we take ice and keep it ice to Ganesha. We take one more eye and keep it in the Munjur. So then that is called carve in. This is a paragraph which is carved in para 6A. Look at this full bold color. This is due exchange difference. See, especially you borrow money from outside India, you buy a machine, then you have to repay outside India. So then there will be two elements. One, there will be exchange difference between the date of borrowing and the date of settlement. Two, your interest for your qualifying period. Anyhow, interest for the qualifying period, you have to capitalize it. Okay, that is the acquisition concession. But the exchange difference, will you capitalize it? That is where this paragraph is there. Okay, so I'll do one simple question also on that. Okay, now please look at this Titan. So borrowing cost incurred in connection with borrowing. The borrowing cost includes interest expense accrued on gold on loan taken from banks. Okay, borrowing is attributed to acquisition construction, takes a substantial period of time to get ready for. Now, what is substantial period? They are very silent. Okay, other borrowing costs are recognized as an expense in the period in which they are incurred. So same wordings in the standard they just give. Okay, they don't further explain on this particular paragraph. So majority of, even for example, I just want to share with you one more. This is what this is which company? Sorry, this is Power Grid. Okay, Power Grid again. I'll take you to borrowing cost. Look at borrowing. All borrowed funds are earmarked for projects. The borrowing cost are allocated to project in proportion to the funds so earmarked. I'll come to this particular portion also. Bond issue, interest, discount, front end fee, back end fee, guarantee fee, management fee, all are borrowing costs. Okay, and borrowing cost is again not defined in here. They say borrowing cost or interest and other costs. Now, what is other cost? Interest in respect of lease liability, exchange difference also is a borrowing cost. That is why I gave the example of you borrow from outside India. Now come to this question. Exchange difference to the extent regarded as an adjustment to interest cost will be treated as borrowing cost. Otherwise, charge up to revenue. Borrowing are directly attributable to qualifying or capitalized as part of the cost intended. Qualifying as well as that like substantial period. Again, substantial period is not defined. Nowhere. Okay. So I have come across many standards. This is one place since the standard. So that is why there is a concept called policy. There is a concept called accounting policy, and that accounting policy can change time to time. Okay. So in accounting policy, you can actually disclose this. Okay. So very interesting point. So where am I? I'm actually here. I'm sorry. So I'm here. So this is now I'll come to this part. So as per IndAS 23, okay, borrowing costs are always capitalized when they are directly attributed acquisition as part of the cost of the asset. Always capitalized. Okay. So now I want to make one observation. Okay, please look at this. Only one observation. So normally it will be always capitalized. Entity shall capitalize or are directly attributable. Now you have some concept called as announcement. So when it is when you have to start capitalize, but you will suspend when the active development is stopped. Okay, during for example, there is because of a pandemic. Okay, because of pandemic, the construction work is stopped. So because countrywide there is a you have what do you call it as shutdown. Okay, so therefore my activity is also shut down. So even though interest will be accrued and paid, that portion of the interest suspension portion will be charged off to revenue. It will not be capitalized. So very interesting part is this. And again, when you will cease capitalization, when it is ready for use, the intended use or sale ready for use. The ready for use is a very important term. These are the places where chartered accountants or accounting professionals doesn't have a role. It's only the technical people. So they'll get a certificate from an engineer, from a technical guy that it is ready for use, you can use for production. So then you can charge up to P&L. Okay. So good. So that is, so 4 is true actually. Okay. 4 is true. Now I'll just take you to one more. According to IndAS 23 borrowing costs, which of the following statements are about capitalization is true? Capitalization will continue until the asset is brought into use. Capitalization continues until the asset is brought into use. So can we say continue? Because in between there can be suspension also. So it cannot be true. Capitalization always commences once the expenditure of the asset is incurred. Now this is a place where I want to bring to your attention one interesting case. I'll just share with you that particular case also, where, so when you will start, what do you call it as your capitalization? Okay, for example, you have a plan you have prepared. Okay, so you borrow the money, you buy the machine, but you have to install the machine or you have to construct the building, and the plan is not yet approved still. So you have to commence. That word is called commence. Please look at the wordings. This is the wordings you need to use. Look at the commencement. Where is the word? Sorry. Commencement. Only incurring expenditure will not be there. You have to incur the interest also. And it undertakes activities that are necessary to prepare the asset for its intended use. It undertakes activities. So what are the activities? That means you have to start constructing. To start constructing, you don't have a plan still. So therefore, building is a cost. So for the building cost, you do some preparatory work. So it undertakes activities that are necessary to prepare the asset. Okay. So you are only in the what you call approval stage. So anything you do till approval, you are not certain that building can be constructed. So therefore, you cannot capitalize. So that is a very important question here. Cap always commences once the expenditure. So you have two other conditions. Cap always comes as soon as interest and relevant borrowing is being incurred. So two conditions. Second condition is here. If the funds are borrowed generally, because A, B, C, you have only 3 separate conditions, but all the 3 conditions has to be satisfied. If the funds are borrowed generally, so that means you have, for example, 3, what do you call it as 3 kinds of loan you have taken at 3 different interest rates, like this question. You have 8% and 4 crores at 10% and 12%. Then what is the average rate of borrowing? So you have to multiply and then divide by 10 crores. So take the 8% into 6 crores plus this 35% of 4 crores are 10%, 65% of 4 crores are 12%, and divide by 10 crores. That will be your average borrowing rate. So funds are borrowed generally, capitalization is based on weighted average. Okay. The answer is D. So guys, I'm sure today there was a feast of information. Can anybody raise your hand to share your thoughts, please? We have Rajesh, we have Satish Kumar, we have Arun, and anybody else who wish to share your thought? Yes. Arun, can you share your thoughts, please? How about Mr. B. Venkateswaran? Good morning. Good morning. Please go ahead.
Good morning. It was a wonderful session.
And please introduce yourself.
Yeah, I'm Arun Kumar. I'm from Chennai. I'm a chartered accountant, cost accountant, and company secretary. I'm working as a controller in Bangalore. So I would always thank you. I got this job also because of the sessions which I attended earlier. So I would always be grateful. I'm still able to apply whatever techniques you teach and tips that you give in my work also. Very thanks. Thank you. I'm very grateful to you.
Welcome. So let us also listen to N. Kumar, Parthasarathi, Rajesh. You can also share your thoughts. Ramadas, we have Ramadas. Renuka. Good morning. Satyanarayan. Shambhumurthy.
Good morning, Raju sir.
morning.
I am a chartered accountant from Jaipur, Rajasthan, practicing chartered accountant from Jaipur, Rajasthan. Your knowledge in the IndAS is very good, or it will help us to clear our exam. Thank you so much.
Thank you. Yogarajan. Veeranjanelu. Varun Taneja. Vaibhav Garg. G. Ramalingam. Sudesh. Okay, so guys, thank you very much. So we'll catch up today evening, and those who have yet to connect with the coordinator for today evening case study sessions, please do so at the earliest. Okay, thank you very much.